This video addresses the important changes that were made to the estate tax provisions of federal law and how those changes may affect your estate plans. I will tell you a little bit about the legislative history of the tax bill, summarize some of the significant tax provisions, and then give you my analysis of what passage of this bill means for your estate plan. For most of 2009 and 2010, the Democrats were in firm control of both Capitol Hill and the White House. Despite their commanding majorities, Congress was unable to pass any major tax legislation. Then, overnight, the election of November 2010 saw the Republicans take back charge of the House, and everything changed in Washington. The Republican victories meant that the new Congress in January would convene with the Republicans running the show in the House of Representatives. A lame duck Congress and weakened president found new incentives to reach compromise, and the first byproduct of that new era of compromise was a major tax bill. Officially, it is called the Tax Relief, Unemployment, Insurance Reauthorization, and Job Creation Act of 2010. Some people have referred to it as the middle class tax cut, but whatever you call it, the tax cut bill was signed into law on December 17, 2010. Passage of this bill brought badly needed tax relief and ended months of uncertainty what the tax field would look like in 2011. The most important news was that the income tax rates were frozen at 2010 levels for an additional 2 years. The postponement of scheduled increases in the income tax rates received most of the news coverage surrounding passage of this bill. If the bill had not passed, income tax rates for most individuals would have increased beginning January 1, 2011. According to the White House, a typical family faced a tax increase of over $3,000 per year had the bill not passed. The maximum income tax rate for individuals was kept at 35% instead of being increased to 39.6%. The freeze is for 2011 and 2012 only, just 2 years, so watch for further tax legislation to prevent another increase for 2013. The freeze is for 2 years only for 2011 and 2012, so watch for further legislation to prevent another tax increase for 2013. Another important part of the tax bill kept capital gains taxes and dividends taxes at current rates instead of having them increase for 2011 and 2012. The alternative minimum tax exemptions were also increased for 2010 and 2011. Had this portion of the bill not been passed, millions of middle-class taxpayers would have seen a stealthy tax increase beginning with the filing of their tax returns for 2010. Also, I just note that child tax credits and earned income tax credits for lower income people were continued for 2 more years. Also, unemployment benefits were continued for another year. And businesses have been given temporary incentive to make investments by being allowed to write off 100% of the cost of their purchases. There's also a Social Security tax holiday for 2011. Perhaps the biggest surprise in the tax bill was the payroll tax cut for wage earners and self-employed individuals. The compromise included a 1-year reduction of 2% in the employee's portion of the Social Security tax. The current rate for employees is 6.2%, and that rate will be reduced for 1 year to 4.2% of wages paid. This amounts to an average savings of $1,000 per person for an American. The maximum savings is a little over $2,000. The payroll tax break is, in essence, another form of economic stimulus to the economy. Now, the estate taxes for 2011 and 2012 were also significantly affected by this tax bill. These changes primarily affect larger estates. Before passage of the tax bill, the estate tax was scheduled to increase in 2011 to the rates and exemptions that were in effect almost 10 years ago. The maximum tax rate would have risen to 55%, and the estate tax would have affected all estates over $1 million in value. The estate tax exemption now, under the new bill, will increase to $5 million on January 1, 2011. For estates of decedents who die in 2011 and 2012, estates under $5 million in net value will have no estate taxes to pay. Also, the tax rate was kept at a maximum of 35% for the next 2 years. Another important change is that the gift tax, the generation tax, and the estate tax are now completely unified. Every one of those taxes has an exemption of $5 million. For many years, estate planners have struggled with different exemption levels for the different types of taxes. Finally, for married couples, the new law establishes an election for widows and widowers that creates what some professionals call a portable federal estate tax exemption. In essence, under the new law, the executor who files an estate tax return for somebody with an estate under $5 million can elect to give the surviving spouse the unused exemption, so that between spouses they should be able to pass $10 million worth of property on to their heirs. In the past, in order to double up the exemptions for married couples, we had to use sophisticated trust mechanisms, sometimes called AB trusts or bypass trusts or Q-tip trusts. The new law gives us an alternative to using these multiple trusts by allowing married couples to add any unused portion of the estate tax exemption to the survivor's estate. But it's important to note that this new law only applies for 2 years. And as it now stands, in 2 years we will go back to the $1 million and 55% rates. Another important announcement is that for 2010 there was no estate tax, and that continues under the new bill. However, there are a few estates that would have an advantage to having the estate tax apply to their estates. And for those few that this applies to, they may elect to have the new 2011 rules apply for their 2010 tax return. So, what are our recommendations for our clients? We are recommending that our clients review their estate planning documents and determine if they should be making changes because of the new tax bill. Most importantly, we have to keep in mind that the new provisions, while very generous, only apply for 2 years, and we are still facing the possibility that in 2 years we will be faced with the old rules that apply the estate tax to much smaller estates. Right now, for 2011 and 2012, a family can pass up to $10 million to the next generation without having to worry about the estate tax. But because the 2013 rules will kick back to the old 2001 rules, when the exemption was only $1 million, we have to keep in mind that many families who right now are going to be exempt will again be pulled back into the estate tax system. So, as a result, we still have to continue to use the AB trust or bypass trust methods because of that possibility. For married couples that have an estate under $2 million in value, you may want to consider whether you want to forego the AB trust and just go with a single trust. Finally, we believe there's a strong likelihood that the estate tax provisions enacted in the lame duck Congress of 2010 will become permanent. However, we cannot rely too heavily on that prediction, and we would recommend that everyone continue to monitor the situation for further changes. It is as true today as it was when the words were first uttered 150 years ago, that no man's life, liberty, or property are safe when the legislature is in session. Accordingly, we always have to keep an eye out for what tax legislation might be coming down the line from Congress. If you'd like to discuss your estate tax situation with an attorney, please feel free to call or make an appointment with our firm. We look forward to working with you on your estate tax needs.